Good morning. I'm Ong Ai Boon, Director of the Association of Banks in Singapore. Thank you for attending this morning's Masterclass. This is the 5th industry webinar we have held this year since the project to transit from SOR to SORA began in August 2019. The purpose of today's Masterclass is for us to share with you a corporate user guide which summarizes 3 other sets of relevant market guides that were published on 27 October this year. We will cover the overview on the usage of SORA in loans, end user checklist, and the market compendium. We have invited from PwC, Mr. Yura Mahindroo, Partner, Financial Services Assurance, who is a member of the Working Group on Accounting and Tax, and he will walk through the guide. And this will be followed by a Q&A at the end of his presentation with 4 work group representatives. Please use the Pigeonhole portal to submit your questions throughout the session. And these questions were addressed during the panel session at the end of the presentation. At the same time, we also like to receive your feedback on today's session, which will be available on the same Pigeonhole. And now, it is my pleasure to introduce Yura to present the corporate guide. Yura, please. Thank you.
Thank you, Ai Boon, and good morning, everyone. A pleasure to be here today with you virtually. As Ai Boon has mentioned, this guide is really intended to cover a number of documents that have been published so far, and it is intended to target the corporate and SME sector of the market predominantly, given that the subject matter we're dealing with can be quite complex and we're conscious can be overwhelming. So we really wanted to put together a user guide that aims to simplify the key concepts involved in a more digestible manner. Just give us one moment while we work through, just trying to get the slides moving. So that's essentially what the guide is aimed at. In terms of the available guidance that is on the ABS website, as Ai Boon has mentioned, there is an overview document on the usage of SORA. There is a SORA market compendium, which we will go through in further detail tomorrow with the SG5 working group, which has a number of details of more technical guidance on contracts for SORA derivative loan and bond products. And then there is an available end user checklist, which provides practical considerations for corporates to manage the transition from SORA. We also have the transition roadmap that provides timelines between now and December 2021 on managing the various interim milestones that we'll need to deal with as you transition your program away from SOR. So perhaps just going through in the next 20 minutes or so the key concepts that are covered in the SORA guide before we turn over to Q&A. So as a recap, in Singapore, the SOR rate that we're using today is really a rate that is available at different tenors. So we have the rate at one day, but really more commonly used at 1 month, 3 months, and 6 months tenors. And this rate is underpinned by transactions that are based off the US dollar to Sing dollar swap FX rates. And really what they're underpinned by is transactions that banks borrow from at 3 months or 6 months. What is changing is we're moving to a world in Singapore, very similar to other parts of the world, where we will move to overnight borrowing rates. So the liquidity, as we've talked about previously, in 3-month bank borrowings and 6-month bank borrowings has reduced, and the shift to SORA is to reflect the fact that underlying bank borrowings have higher liquidity in overnight cash transactions. So that's one key change. The second key change is that SOR has been historically dependent on the US dollar to Sing dollar FX market. And by moving to SORA, we will now be moving to a rate that is entirely based on Singapore cash market transactions. So we won't have a link to the FX rates any longer. So in very simple terms, if you look at what the SOR rate is, it is really the rate that banks, it was underpinned by rates that banks would borrow from and pay from back to each other in 1, 3, or 6 months' time. And what that meant for you is that for many corporates, it meant that whilst you had a variable or floating rate, in effect, you had a fixed period for 3 months that then reset and then fixed again and reset. And of course, by moving to SORA, which is an overnight rate, you now have, in many ways, a truly floating rate that resets every day. So it changes every day, rather than being fixed for 3 months and then reset and then fixed again. So what that does is it does mean that it will change the way interest is calculated, and we'll touch on that in a moment. The other thing that happens is because the previous rates of 3 months or 6 months or 1 month carry interbank credit risk, so there's a fear factor, if you like, that if a bank lends to another bank, they don't pay you back in 3 months' time because they fail, and it does happen, as we've all seen with Lehman and others many years ago. So there is an element of interbank credit risk that is carried within traditional rates, so SOR, LIBOR rates, and so forth. That is very negligible as we move to overnight rates. And that's in very simple terms because if you looked at a SORA rate, a bank is borrowing from another bank or lending to another bank, but it's very likely that if you lend to that party today, they'll be around tomorrow. So essentially, economically, there will be a difference between SORA and SOR. And one of the key drivers is that there is less interbank credit risk in this new rate. As we walk through the SORA guide, one of the key concepts that we are hoping that all corporates and SMEs can take away is that because of this move to overnight rates, as opposed to sort of having this fixed rate for 3 months that resets, is that until the future derivative markets develop, there is really no way to look forward in time and say what will be the interest that I will pay in the future. So today, for many of you, your setup is that if you have a variable rate loan contract, what happens is, let's say you're at the 31st of December, your first interest payment on a 3-month contract is fixed for the next 3 months. So you know that you will pay, let's say, 1% plus your margin at the 31st of March. As we move into this new world, we are going to have a scenario where we won't know at 31st of December what that interest payment will be because it's going to move every day. So we will have to wait till the 31st of March and then look back and say what has been the average of every daily movement. That's called compounded average interest, and that's what we will see more commonly as we move to SORA. Of course, this does create some difference to corporates because you no longer have certainty of when your interest payment will be made. And so to address this, there are a number of conventions or mechanisms that help to try and give you a bit more time between that 31st of March time when you know what the interest is based on the last 3 months and when you have to pay the interest. So almost like a time delay. So to walk us through this, there are a number of conventions that many of you will hear about that can sound a little bit alien as we talk through these, and I'll touch on them in a minute. But one point I wanted to stress is that in Singapore, there is a mechanism that is going to be used for the corporates that don't commonly apply hedging, that is referred to as compounding in advance. And what this is in that example I've just described, you would look to you would get to 31st March and you would look back, let's say over the last month, and you would average the rate, and that would be the rate that you will pay at the end of April. So you have a 1-month lag, if you like, between the interest you're paying and the time over which the compounding calculation works. So in Singapore, that's a product that we will touch on a bit later, but that is going to be introduced, very targeted towards the SME and corporate market that does not intend to do a lot of hedging. But for the wider or larger institutions, we will see compounded in arrears calculations supported by different conventions that move a little, give you a few days, if you like, of delay to allow payment to be made. So maybe just to touch on those points a little bit more. There are broadly 4 conventions, and some of these are more recommended for certain products than others. Essentially what these conventions do, and I have 2 up on the screen now, is they, as I say, they give you a bit more certainty on what the cash flow is just before interest is paid. So the first convention that's on the screen now talks about a lockout period, and this is probably less commonly used in Singapore, but still a convention that may arise. And what this is that if you looked at a 3-month period, the last 5 days of daily interest rates don't move. They're kind of frozen. So that gives you some ability 5 days before to kind of average out your interest for the previous few days or previous days and determine your interest payment. A more commonly used product or convention that we're seeing in Singapore is a look back without observation shift. And really what this is you really take the day's rate from, let's say, 5 days previously and replace it with today. So again, what this does is it gives you 5 days more time at the end of the interest period where you know what your interest payment will be. This is a product convention that we are likely to hear more about in Singapore, particularly on loan products. And Jonathan will talk about this a little bit later on. There's also look back with observation shift. And this is very similar to the previous convention that we just discussed, with the exception that rather than replacing the day's rate by the rate 5 days ago, you're really shifting the entire interest observation period to 5 days earlier. It can sound like the same thing, but it makes a very small difference where you have weekends in between and so forth. So it has a very slight difference. But both of these, again, just come back to that convention in allowing you more time to make your interest payment. For derivative products, the convention is more likely to be along the lines of a payment delay, which is that you get to the 31st of March, and then there's really 2 or 5 days of, typically 2 days of lag before you make the interest payment. So it is worth the larger corporates being aware of these different conventions, and more importantly, recognizing that the conventions can differ by product. And for those corporates that hedge, it is worth discussing with your banks early where there is a potential difference in convention and how you can cope with it internally, and whether there is a conversation with the bank on alignment that should happen. As I touched on at the start, there is a difference economically between SOR rates and SORA rates. SOR rates are that you would typically see when you're lending or when you're borrowing from your lending bank, look something like the top half of the page in front of you, which is really you have a 3-month SOR rate, you have a customer spread, and that is your all-in rate that is paid. Now, what you may not see is that implicit within the 3-month SOR rate is a interbank credit risk and also a term adjustment or a term premium, because it's a 3-month rate, not an overnight rate. As we move to the future, as you move to SORA, what will happen is there needs to be some way of adjusting for these 2 elements. So firstly, the SORA rate is a day rate, whereas 3-month SORA is a 3-month rate, so there's a tenor difference. And secondly, that, as we touched on earlier, there is a credit risk premium in 3-month SOR that really is very negligible in SORA. And so what this will mean is when these elements are split out, whether it's to do with historical contracts or on new contracts, there is some new adjustments that will need to be incorporated into the new customer spread. Okay, I'm conscious that for many of you, there's words like fallbacks which are going to be quite alien to most of us until we've started to deal with IBOR. But what contract fallbacks are, in very simple terms, is it's a legal backup clause in your contract, in most contracts today. And I say backup in the sense that it is designed at the moment as a backup for a temporary dislocation of LIBOR. So LIBOR is not published for a day or a week. This is a mechanism that would say in the contract, let's look at the fallback, and that's your backup rate. Of course, the issue with existing contracts is that these fallbacks are designed for a temporary dislocation and not a permanent dislocation. And so with a permanent dislocation of LIBOR, it is in your interest really to move away from these existing fallbacks because they may not be economically equivalent to the new rate that you're moving to, and they also may not be easily hedged. So it's a conversation with your bank to really understand what is in your contract fallbacks and whether they are fit for you going forward. In Singapore, as we move derivatives and loan products to SORA, the existing SOR derivatives and loans will fall back to a temporary rate referred to as fallback rate SOR. Now, this is a temporary rate, and it's really designed for existing contracts, not for new contracts. And it's there as a way to ease the mechanism of moving from an FX-derived rate, which is what SOR is today, to something that is overnight and completely in the Sing dollar market, which is SORA. So this temporary interim measure is to move back to a calculation that still relies on the US dollar and US dollar to Sing FX rates, but uses the US dollar new rate, or SOFR, as the input rather than US dollar LIBOR. So that's what fallback rate SORA is. Both derivatives and loans, derivatives through the ISDA protocol, which we will touch on in a moment, and loans through recommendations are expected to fall back to this rate. Again, when it comes to these fallbacks, it's worth discussing with your bank early to understand the implications of any hedging that you might take on. The one point to note on fallback rate SOR, so this will be a mechanism for any derivative or loan that isn't continuing, or when the rates expire, so when SOR is no longer available, is that fallback rate SOR is going to be published in arrears, not in advance. So for corporates, when SOR extinguishes, it is worth noting that whilst it sounds like SOR, fallback rate SOR is actually a rate published in arrears. So it's worth considering how you do interest accruals as you deal with this new rate. Okay, what I wanted to touch on now is really just a brief overview of some of the changes that are happening to derivatives, loans, and bonds. Perhaps to talk through the derivative changes briefly, I might invite Matt Lepine from SG1 to just share a brief perspective on the changes here.
Yeah, sure. Thanks, Yura. So on the derivatives, we've flagged the key changes that are impacting the markets, and I think it's very useful and practical to understand in one single place, one single slide, what are the impacts on the market. So in the derivative space, basically all swaps involving SOR will be impacted. And to understand what they are going to move to, well, very much in like with the new benchmark, which is called SORA, the intention is to transfer SOR swaps to SORA, where SORA would be compounded in arrears. So that will become the new benchmark or the new way of hedging rates for the Sing dollar market. Now, for a transitional perspective, there will be contractual mechanisms that have just been announced by ISDA to incorporate better fallback or more solid fallbacks within the existing definitions. So this is the new ISDA definition that will incorporate the full waterfall, the full methodology, to understand what happens when a specific rate, like SOR, is being discontinued. So that's very important to understand. There will be two markets, one which is the future benchmark market, SORA, and one market that's here to help or facilitate the transition, which is based on fallback rate SOR, which will apply via ISDA protocol if you choose to sign up for the protocol. As Yura just mentioned, there will be a fairly broad range of conventions and details. And I think one very easy way to simplify your execution of transaction is to refer to the MAS published SORA index. And just like today you have LIBOR available on a screen and you can refer to that specific number, you can also use a very similar number for SORA that will factor in this compounding that we have been discussing. To keep things simple and efficient, there's been a series of template confirmation that have been published. And again, this is to facilitate transition from SOR to SORA, and very important to engage with the different stakeholders when you are transacting. In terms of convention, so again, it's very important we are moving to indices that are overnight, which is very, very different to what most of us are used to in terms of forward-looking interest rates. So we will see conventions, meaning specific ways of dealings by default, established in the market. In the interbank market, that convention is going to be a payment delay, meaning that you observe SORA every day of your interest period, and you pay 2 days after the end of that interest period. Please know that this is only a market convention. It doesn't mean that you have to deal that way. And of course, derivatives are flexible. Your derivative is going to match your underlying transaction, for example, a loan or a swap. So for existing SOR derivatives, the fallback protocol has been published by ISDA very recently, and that will ensure a contractual transition to fallback rate SOR. And these fallback can actually, or will actually be integrated by default if you transact from 25th of January 2021 onwards. And I think the last point that's very important for derivatives and for all other transactions is that this transition will actually be triggered by an announcement from regulators or when LIBOR ceases to be published.
Thank you, Matt. And maybe in a similar vein, on the capital markets side for bonds, I'd like to invite Ki-Pong to perhaps share really briefly an overview.
Yes, thank you, Yura. The products that would be impacted under bonds would be floating rate securities, resettable fixed rate bonds, for example, perpetual or hybrid securities, or bank capital instruments such as Tier 2 or additional Tier 1 securities. For new contracts referencing SOR, for example, the reference rate used could be forward-looking term SORA. In the absence of term SORA, SORA compounded in arrears is also the recommended benchmark. In terms of credit and term adjustment spreads where they apply, it would be very similar in approach as Yura had described earlier in terms of credit and term adjustment spreads. So from that perspective, it would be similar also to how the loan market would look at it. Payment conventions would be look back with observation shift, as well as look back without observation shift. These two are the possible alternatives or options that the market can choose. For existing legacy bonds that are impacted, that have been issued under SOR, the fallback hierarchy when SOR is no longer available will be term SORA if that's available. Falling next would be compounded SORA in arrears, and also other alternative rates where the market can find comfort and credibility in using. Right. For fallback hierarchy, there is a slight difference. So this would be a point to note than for derivative products. So for legacy contracts that have overlaying derivative contracts over the underlying bond, this is something to take note of. Issuers who hedge may also want to amend bond fallbacks so that they are able to match the derivative fallbacks to take into consideration hedge accounting objectives. Issuers should always consult professional advisors when considering an adjustment spread, and also discuss, with their relevant bankers about this matter.
Thanks, Kee-Pong. And last but not least, Jonathan, a brief overview on loans.
Thanks, Yura. So I'm now going to go over the impacted products for loans, as well as what we expect to use for loan conventions and how existing SOR contracts will change. So just to be clear, this impacts floating rate bilateral loans and syndicated loans. We expect new contracts to progressively reference compounded in arrears SORA. So this is the calculation methodology for SORA that Yura just described a little while ago, that involves observing the overnight SORA rates over a month and calculating the interest accrued at the end of that month in arrears. We can already see there have been a few announcements of pilots done by some banks in the local markets referencing such a rate. For SMEs, or more broadly for loan transactions where simplicity or payment certainty is preferable and where hedging is not required, alternatives like the compounded SORA in advance that Yura spoke about, or of course bank administered rates can also be considered. The expected SORA payment convention is a 5 business day look back with an observation shift, or a 5 business day look back without an observation shift. These are aligned with global conventions using such overnight rates for the computation of interest. If some of the landmark syndicated loan deals, such as these are public deals done with Shell or British American Tobacco, have referenced similar conventions as well. For existing SOR contracts, the working group recommends that the fallbacks follow the hierarchy shown here, with the primary fallback being the fallback rate SOR. Additionally, we would also note that for syndicated loans, the Loan Market Association has published a template clause, which is endorsed by the APLMA as well, that supports the transition to SORA by reducing borrower consent thresholds required to make amendments to interest computation for that loan contract, and also sets clearer definitions around what benchmark discontinuation is.
Thank you, Jonathan. So with that overview of the key products, perhaps just worth turning to what really corporates should be doing next. Now, on the ABS website, there is available materials that are designed to help and are designed for 2 segments of the corporate market. There is a simpler version for corporates that do not use derivatives that often, but predominantly use simple borrowings, and a more extensive checklist, if you like, for corporates that are involved in a more extensive use of financial contracts. Essentially what these checklists cover are the key steps that we recommend you take as you prepare for this change and for the eventual removal of SOR and discontinuation of SOR. So the steps are really to appoint and have a governance mechanism in place for regular reporting to board and senior management of how your project and program is going to manage transitions from SOR. Starting to then look at quantifying what are your SOR exposures. And whilst the predominant SOR exposures are within financial lending contracts, derivative contracts, and bonds, they can exist in areas where certain corporates extend financing to their customers, or in other arrangements as well. So it is worth having a bit of a wider look to understand where you're exposed to SOR. And then really starting to dig into those contracts, because unfortunately things like contract fallbacks are not maintained in data that your existing organization is likely to have. So it is an exercise to really go into the contracts themselves and say, look, if I have contracts beyond 2021 that are SOR-based, really what will happen? What is the existing fallback? And that will help you devise a strategy as to what you need to do as you discuss with your bank counterparts. So should you renegotiate that contract, or should you really repaper that contract? So you just move to a new rate, or should you try and amend that existing contract but with stronger fallbacks? So that decisioning really can only come after you've looked into the contracts in a bit more detail. Of course, as you look at this, the compounding in arrears conventions, there is a significant change to operational processes such as settlement systems that need to take place. And it's worth understanding those impacts early, as well as to discuss with technology systems vendors whether they have the capability to support the change as you move forward. Of course, as you're doing this, for many corporates, it can be a bit overwhelming to look at the calculation to say, do I need to calculate daily compounded average rates and so forth? And again, just to highlight, the MAS published compounded SORA rate and SORA index are very useful data that can be leveraged and should be assessed early to see if they're fit for your purpose. It really does the calculation for you, and therefore it should be something you can look at, assess, and say, okay, if I leverage this resource, I don't need to do the calculation myself. And then, of course, there's tax and accounting aspects that we've covered in a previous masterclass, so I won't go into now, along with treasury risks. So perhaps just to wrap up before we go into Q&A, so key takeaways and recommendations across, I guess, the three sectors of the market that we're seeing. For borrowers, really understand, as we've touched on, the available indices and understand how that impacts your business. So how can you use these rates for your calculation of interest payable and receivable? Starting to minimize the number of contracts you have that reference SOR, all fallback rate SOR, by considering where you can transition to SORA contracts, repaper to SORA contracts where possible. And of course, discussions with your bankers early is something we recommend to really understand some of the intricacies that we've talked about around conventions and so forth, as well as using the checklist that we've touched on. For issuers of floating rate products, again, floating rate products and bond products can be a little bit more bespoke and a little bit more complex. So it is worth discussing with professional advisors early, and it is worth considering your disclosure obligations to the market as you think about new issuances and prospectus documents. And then for corporates that hedge, again, Matt has touched on the ISDA fallback protocol, which is a very helpful mechanism to really almost automate the update of historical legacy derivative contracts. But it is worth understanding the mismatch risks between those products when you sign up to the protocol versus the underlying loan or bond you're hedging, including understanding where conventions might be different, so that you can engage in a discussion with your bank on whether the ISDA protocol by itself is fit for purpose or amendments need to be made. So with that, hopefully we've covered an overview of what is in the SORA guide, and we'll now turn to questions. So I can see that we've got a large number of questions that have come through, so we might get straight into it. So the first question, and I'll of course leverage the panel we have today to help address these, So first question is, ICE has just released consultation to its intention to cease publication of 1 week and 2 month US dollar LIBOR by December 2021, and the remaining by June 2023. Do we expect sourceization to also follow this timeline? So great question. I'm just thinking who in the audience would like to take this. I'm conscious Joyce has not had anything to say so far. So Joyce, we might turn to you to start, and then of course we'll all jump in.
Sure, thanks, Yura. It's probably good that legal comes last anyway. I think it's a great question because it's come in the news overnight. So to be fair, I think a lot of us in the industry are thinking about and talking about this question in any case. I think the short answer is that the SOR-SORA steerco is going to have to consider and think through what this means for our Singapore dollar SOR-SORA transition, and whether the SOR cessation timelines should continue to follow US dollar LIBOR. It does at the minute because they're tied to the same triggers in the ISDA protocol at the very least. So it is something that we'll have to digest and consider. So I suspect this is going to be something we have to watch for further news and development on. I'm not sure if Kipong and Matt have any thoughts on that in your space as well.
Yeah. So I think the announcement was very timely, just arriving last night, just before this session. So I think it's great that we have the chance to cover that. I think one point I would like to flag, well, first, clearly it doesn't mean the transition is stopping, and there is clearly no such message coming out in that direction. And one point that is very, very important to flag is that this announcement, and that we still need to clarify because it was just an initial press release, was clearly catered to facilitate the transition of legacy contracts, right? So it's really to ensure that legacy contracts are less impacted by the transition, or to allow a smoother transition from that perspective. But it doesn't mean that the adoption of new RFR should be delayed, and I think all the other timelines with regard to the adoption of the new benchmark rates are still up and running, and a lot of them are occurring in the first half of next year. So I think, yes, maybe some potential relief on legacy contracts, but clearly the plans to go ahead with the new benchmarks are still very much there.
Thanks, Matt. Jonathan, did you want to add?
Yeah. I think one important thing to note about the announcement, the very recent announcement about dollar LIBOR, is that it came accompanied by a request from US regulators, the Fed, the FDIC, and the OCC, asking US banks to stop originating dollar LIBOR contracts, all contracts, as soon as practicable, and certainly before 31st December 2021. So we think that suggests that the timeline for stopping origination of LIBOR products in any case continues and does not change. And so this buffer is more to allow for legacy products that are already on the books to run off, so that the amount of amendments that need to be done may be more tractable for dollar LIBOR.
Thanks, Jonathan. I think that's a really good point. I'm conscious that many people read the news overnight, saw 2023 and said, thank God we've got a bit more time. But I think that's a really good point that, all of the regulators have, or most of the key regulators have timelines for stopping new issuance on legacy IBORs, and those timelines are very early next year, first half of next year, and so forth. So there really isn't a delay, unfortunately, for you in terms of your preparation for this change. We have a question on trade finance. So what rate should be used for trade finance, given that there's a requirement for certainty for discounting? Jonathan, perhaps sticking with you, any comments?
Sure, thanks, Yura. The industry discussion that we've seen around trade finance, particularly from the UK risk-free rate working group, have pointed to the use either of term rates or in advance fixings for these types of trade products, in particular discounting type products. So these types of products may be may be able to reference compounded in advance SORA, or alternatively term rates such as bank administered rates or term SONIA, for example, once that is finalized in the sterling market, and similar other term rates for other currencies.
I think there've been a couple of trade finance deals done already that use the in advance method, because as the audience member who put that question did point out, for trade finance, you do need to know your rate in advance in order to be able to do your discounting. So we are aware of a couple of deals out there where they have used a compounded RFR, but applying it in advance in the way that Yura had described. So we may certainly be seeing that developing as we go forward. And when a term rate comes on, then I suspect people will move on to that. But we don't really have a lot of certainty right now about when term rates in any of the RFRs are going to become available. So compounded rates applied in advance is probably the best thing that we have for now.
Thank you, Joyce. Switching tack to some of the questions on ISDA. So is the convention two business day backward shift that applies under ISDA IBOR fallbacks the same as the convention 2 business day look back with observation shift? I might just turn to Matt just to perhaps shed some color on the ISDA convention.
Yeah, sure. I was hoping you would turn to legal for that one. No, so I think, yes, the conventions, again, are going to be a little complex because they are all fairly technical, and their impact can sometimes be very, very small, but can be very, very difficult to manage. And I think that's one of the big concerns people have around moving to overnight-based interest rate, because they tend to be a bit more challenging to manage. So if I get the question right, my immediate intuition is yes, it should be quite similar. My point, which is maybe a nice way to evade the question, but I think it's probably more important, if you have a derivative on a standalone basis, honestly, I think it will not really matter whether you are shifting by 1 day specifically, because overall you will have 99% the same fixings. What I would strongly encourage you to do, and I think what Yura mentioned earlier, is if your derivative transaction was entered to hedge an underlying derivative. In that case, it's very important to ensure that both contracts are falling onto the same convention and the same calculation, because it has impact in terms of cash flow mismatches, potentially in terms of hedge accounting. And again, the ISDA fallback can be used as a default solution, but you can always overwrite that by bilateral agreement. So for example, if you've entered into a specific project finance hedge and you want to ensure that your interest rate swap is matching your underlying project finance financing, you need to look at both contracts together to ensure that they will have the same fallback convention, the same transition timing, and so on. So I think that's really the point I would keep away from that question.
Thanks, Matt. And Joyce, anything to add?
No, I don't think I have much to add. I think they are substantially the same thing. We're just using slightly different terminology. In relation to 2-day backward shift versus 2-day business look back observation shift. But I think we can't emphasize enough this question about an early look through your books, if you're a corporate or a borrower or an issuer, to see what you have by way of loans or bonds and swaps, and then to go and talk to your banks early as well. To this point about derivatives having a very standalone set of conventions that the market understands, but has always been flexible enough to be amended and to be bespoke for any loan or hedge, loan or bond that they hedge. So it's better if you start talking to your banks early, but you can only really do that if you get to the bottom of what your portfolio looks like. So I think we're probably going to be seeing or hearing that quite a lot, but I think that is something that's pretty essential for the market to get its head round. Otherwise, readiness will always be a concern, whether we see a delay or not because of the announcement overnight.
Thanks, Joyce. All right, we have one question that's gaining in popularity very rapidly, so I will pick that now. Is there any guidance on the calculation of spread adjustments for contracts that transition from SOR to SORA? So very good question. We do hear about it a lot in the market. Jonathan, perhaps firstly turning to you.
Thanks, Yura. So as Yura has described a bit earlier on in today's session, the industry group recognizes that there should be a spread adjustment that accounts for the differences in term and credit premium between SORA and SOR. When you look historically at how the rates have been observed over the last few years, generally there has been a positive spread adjustment between SORA and SOR, which would mean a certain adjustment to be added to SORA in order to make the rate economically equivalent to SOR. There is currently no broad blanket guidance on the sizing of spread adjustments for contracts transitioning from SOR to SORA.
Thanks, Jonathan. Matt, any comment?
Yes, so I think on the derivative side, I just want to clarify maybe one point here. When we look at US dollar LIBOR, which is the other market most of us will be familiar with, the default fallback is to move from a LIBOR rate to an RFR, or risk-free rate, an overnight rate. And there will be a spread used to convert LIBOR to the new benchmark to reflect the time difference and the credit spread. For SOR, the transition is slightly different because the default transition, the one that would apply if you join the ISDA protocol, would be to move from SOR to fallback rate, SOR. Okay, so important to understand that by default, the transition doesn't move to the new benchmark rate. It moves to a transitory rate, which is fallback rate SOR. So that's why there will be no such actual guidance directly in the market, because that transition doesn't automatically brings us from SOR to SORA. You can actually move your SOR or your SOR contracts to SORA. To do that proactively by recontracting or changing your contracts. And there is a growing market to convert your SOR exposure to SORA exposure. So it is something that is doable in today's market.
Yeah, thanks, Matt. Okay, we have a question on term SORA, which is very popular. So simple question, term SORA, what is the timeline? That's a good question. I might turn back to you, Matt. Being in the derivative market, we know how important that is to facilitate term SORA.
Yes, so I think So first, is there a timeline for it? I don't think there is. So it's, again, very important to understand. A lot of markets participants in the US, UK, in a lot of Asian markets have been asking for a term SORA. For those who are not familiar with what term SORA means, it means it's an interest rate that is defined using SORA as an underlying, but that's defined today for the next upcoming 3 months. And how does one do that? Basically by relying on the derivatives market, the swap market, and see what is the cost today to fix SORA for the next 3 months, for example. So it very much looks like LIBOR when you think of it, because it relies on banks contributing to some rates. And that's why regulators across the globe have been quite reluctant to use term rates, forward-looking rates, as a default benchmark. It doesn't mean it will not exist, but it will only exist once you have a deep and liquid SORA swap market. And it might exist only for specific situations. Looking at the sterling market in the UK, which is very often quite advanced with regard to the transition, they've been consulting around a term SONIA rate, and the initial direction was to use term SONIA only for specific situations where SONIA compounded would not be applicable. So it could be, for example, for retail, which are better accustomed to forward-looking rates, or maybe like trade finance, where you need to do discounting and you need to know your rate in advance.
Yeah, thanks, Matt. Look, we had a similar question that came up, and I think you addressed it, but maybe just to round it out, the question was, what is the difference between term SORA and compounded SORA in arrears? So I think Matt addressed the question, but perhaps just really briefly, when we think about term SORA, and as Matt has said, it's a 3-month forward rate, it is really based on expectations of what the interest rate will be in the future. So you know, I think the interest rate is going to increase or decrease, and then I calculate that market. And if there's enough trading activity, as Matt has said, then you get liquidity in that market to be able to say, yes, everyone's expecting it to, let's say, go up in 3 months' time and this rate. Compounded SORA in arrears would be what has been the rate yesterday for 1 day, and then let's look at it again every single day. So it's a backward-looking rate rather than based on expectations. So a good question, changing tack slightly, but again staying with Matt. Since fallback rate SORA is not recommended as a rate for migration, why is this used or as a fallback for derivatives?
So I'm not sure where is it not recommended as a rate for migration. So I think, again, there will be a bifurcation in the markets, right? The future benchmark is SORA, and to help end users like corporates in particular going through this transition, another temporary rate, which is fallback rate SOR, was plugged in to avoid any gaps in the transition, so to ensure that there is contractual continuity of all your contracts. It was not used by chance or chosen, I would say, in a loose manner. It was chosen after an industry consultation that was involving not just banks, but a broad range of market participants. And because SOR is very, very specific, being a composite rate using US dollar, LIBOR, and the FX swap dollar SING market, it was not so natural to transit directly to SORA. So I think that's the slight complexity we see in the SING dollar markets. But I think quite importantly, nothing prevents you to actually proactively change your contracts to SORA and basically completely forget about fallback rate SOR. Fallback rate SOR itself having a shelf life of an estimated 3 years. If you are comfortable with it, it might as well be better to jump completely to the future benchmark rate, which is SORA.
Joyce?
Okay, I'll add a little bit, but Matt covered a lot of the essential points. The ISDA consultation was a market-wide one, right? Banks, buy-side, even regulators had contributed. And it was a majority response, I think, when we looked at where SOR was going to be. And because SOR, along with other rates that use US dollar LIBOR, Thai baht fix is the other one that the ISDA protocol picks up. They both have the complexity of FX swap points plus US dollar LIBOR making up the rate. So I think what we saw in the consult was the market did consider other options, but one of the factors taken into account was that it was probably a closer leap from SOR to fallback SOR, where you still had FX swap points, and you're replacing the US dollar LIBOR input with the identified fallback for US dollar LIBOR. And that may be an easier or more comfortable transition for some players in the market rather than going straight to SORA, which is, as we've heard, fundamentally quite a different benchmark, how it's calculated from SOR. So that's the extra complexity and subtlety that we have to deal with in the Sing dollar market that doesn't exist in, say, the US or sterling market. And it does give us this dual track of considering the fallback SOR as a safety net, a default, an interim contractual fallback, an easy way to migrate your legacy contracts if you use the protocol, for example, for your swaps. However, if you're already able and willing and are able to engage your banks early, then the messaging, I think, from the regulator here is try and use SORA, because otherwise you may end up for long-dated positions transitioning from SOR to fallback SOR in stage one, and then if that particular swap extends its life beyond the shelf life that Matt mentioned for fallback SOR, which is around about 3 years after SOR discontinuation is triggered, then you're going to end up with another transition from fallback SOR to SORA. And I suspect that that's something that we might all want to avoid, doing a two-stage transition or repapering rather than a single one from SOR to SORA. Yura, handing it back to you.
Yeah, thanks, Joyce. And I think the key word there was really that when we look at fallbacks, it's a safety net. So it's not a perfect solution, it's a safety net. In my mind, the way I kind of think about all of this is if you have a SOR loan and do nothing, that's kind of, and SOR disappears, it's big business disruption, contract frustration, a big problem. Then you have a waterfall where, okay, well, to avoid that, let me keep my SOR loan, but improve the fallback. So at least if SOR was to discontinue, there's back to something that is better. So that's good. It's kind of, it's not the end of the world. But the best and the least problematic is if I can agree with my counterparty to just go to SORA, and therefore we're kind of in the new world already for that legacy contract. So that's how I see the world of your old contracts. Of course, the new contracts, just if you're able to write those contracts on SORA, you're saving, you're in the new world, right? So you're outside of the pain. So sticking with fallbacks, there was a question on fallbacks again. So fallback SOR is intended to replace SOR upon cessation. Can borrowers opt to transition legacy SOR loans from SOR to fallback SOR earlier? So rather than wait till December, can we go 1 July 2021? So it's a great question. Jonathan, perhaps to take this one?
Sure. I think the short answer should be yes. There shouldn't be anything stopping a borrower from talking to their bank to review if everything's ready to transition an existing SOR loan to fallback SOR earlier. In fact, fallback SOR has started being carried by Bloomberg since early October this year. So if you have a Bloomberg subscription, you can actually look it up and see what it is across all the different tenors. So I mean, obviously this is a rate that only just started being published on Bloomberg, so there needs to be some work around getting processes in place so that it gets sorted out properly in all the systems. But conceptually, there should be no reason why you can't start talking to your bank to see when you can move your legacy SOR loan to a different benchmark.
Thanks, Jonathan. Joyce, anything to add to?
No, no, not really. Early is better. I think we've said it numerous times now. And I know that some borrowers have said it's difficult to engage your banks, but one of the things I would say is be persistent, talk to your RMs and your sales contacts, and make sure that you're kind of early in the queue when you want to have a discussion about moving your legacy SOR products. Because you then have the choice of an option, right? Whether you end up in that default safety net position of just transitioning to fallback SOR, perhaps because you have swaps that are also going to use fallback SOR, or moving to SORA directly. So I think that early engagement is pretty key. It does leave you with, I suspect, more options to discuss than if you leave it too late and then you are just ending up in that default position.
Thanks, Joyce. So this is great engagement. We've got lots of questions coming in thick and fast, which is great. And of course, Keep Hong is unfortunately not getting a lot of love on the bond market. Maybe it's too easy. So next question is, will an industry regulator published spread adjustment be beneficial for a smoother transition to SORA? Again, very good question. Just looking at the panelists who's keen to tackle this one. Matt, yeah, thank you.
I can try. So, yeah, obviously, like there are many ways to make the transition smoother. I think this question indicates something that's quite positive, is that many of you are considering moving to SORA directly and not use the fallback rate SOR, which is, again, just a safety net. And it's very important to consider proactive change towards the new benchmark, which is SORA. So I think that's very good. So my personal view, I think yes, it will be beneficial. What do we need for this spread adjustment? Or a spread adjustment, it's something that applies automatically, but I think more generally, it's important to have an easier way to transit from SOR to SORA. To be able to do that, you need to have a liquid market in what we call a basis market, which is two floating rates. One is SOR, one is SORA, to allow for the transition between the two. I think this market is growing pretty fast, and already today, if that's your intention, you can consider converting your derivatives from SOR to SORA. So do we need an official spread adjustment to be able to do that? I don't think so. I think we just need a market to be available to do that. And I think that market is getting there and hopefully will become more and more liquid. And very soon you will be able to check it on a screen, just like you check your $1 interest rate swap, basically.
Thanks, Matt. And we had a related question, which was, for loans with swaps, how can the spread adjustment be aligned? And if not aligned, how do we address the spread difference? And Jonathan, perhaps over to you.
Sure. So for loans with swaps, the recommendation of the industry group is to use fallback SOR, because fallback SOR is the fallback rate to which SOR will transition via the ISDA protocol. So since the ISDA protocol is set up that way, it makes sense for loans that are hedged with swaps to follow that interest rate as well to prevent hedge ineffectiveness. In such a case, there will be no explicit add-on spread adjustment because fallback SOR simply imports the spread adjustment from fallback rate SOFR, which is the US dollar fallback rate. So I mean, just to get around that technicality, those technical details, right? Essentially, there's no need to align the spread adjustment if the loan follows fallback SOR, which is the interest rate the derivatives will be going to.
Thanks, Jonathan. Jonathan, a question on syndicated loans. So can fallback SOR be used as default standard instead of having to negotiate with every lender a replacement rate?
Okay. For Sing dollar syndicated loans, I think this depends on a number of factors. Chiefly, it is that fallback SOR has a shelf life. So the expectation as announced by the steering committee is that fallback SOR would end about 3 years after SOR discontinues, with the intention certainly not to maintain a fallback SOR publication indefinitely. Now, many syndicated loans mature beyond this shelf life. So for example, if SOR were to end in end 2021, then fallback SOR ends in end 2024. So for anything maturing beyond the end of the shelf life of fallback SOR, you would have the unfortunate situation of needing to be amended. The loan will have to be amended twice if you have a loan that matures beyond that point. So fallback SOR won't work as the default standard for quite a large set of loans. But if the loans mature before the end of 2024, then it may make sense for that to be the standard for syndicated loans that are transitioning.
Joyce?
I think to pick up on one more part in the question, for syndicated loans or your big structured finance, project finance loans, there are usually facility or payment agents or trustees involved. And we would expect that in those cases, the agents would be the relevant party picking up the loan document or hedge amendments for those big loans. So it's not about individual borrowers or SPVs, which some of them are, having to approach each lender to negotiate a new rate. As far as we're aware, I think some agent banks have already started reaching out to borrowers and lenders in some of these big financing deals to already begin conversations about what to do. So as Jonathan mentioned, you could look at fallback SOR, or you think about refinancing your package right here and now for your loan and your swap, and maybe go to SORA direct. But we would say that that probably would be a responsibility for the agents in those deals, and also those big deals do tend to have deal counsel. Your law firms will normally be involved in helping to negotiate and amend not just your loan agreement or your swap, any security documents that are likely to need amendment as a result of the change to your benchmark as well. So in some ways, that class of loan and product probably has a different amendment approach, and the responsibility should be lying with your agents. If you are a borrower and you haven't heard from an agent in a deal that you're in, which is a big syndicated deal or project financing deal, then perhaps it is something that you should have a word with your agent about if they haven't reached out yet, and you are a borrower. So something to keep in mind.
Thanks, Joyce. Okay, we're going to switch tack, and we've got an accounting question, so this is something I think I have to take. So hedge accounting, would a mismatch of observation period between the interest rate swap and loan cause hedge ineffectiveness? So it's a very good question and quite a common one. To address this, let's look at the scenario where you're looking at a difference of, say, 5 days or 2 days for most of the conventions that we talked about. When we have mismatches like that, I think it's important to note that economically there will be some difference in interest that is paid between the swap and the loan. So let's say on the swap side you have a 5-day difference, and actually the interest that's calculated is 1.2% for those 5 days. On the loan, let's say it's 1.1%. Your P&L will reflect that actual cash difference. When it comes to hedge accounting, so in the more traditional sense of the word, what we're doing is we're forecasting the interest payments in the future over the next, let's say it's a 3-year loan, so 3 years or 5 years, whatever the term of the loan is, so the future. When you do that, the observation period mismatch of 5 days, 2 days will have no difference, because really what you're doing is you're projecting future points on the curve of the SORA curve, and you're projecting future points at 1 year, 2 years, 3 years, and there's no difference at that point for a 5-day observation shift or a 2-day observation shift. So that's an important point to note. So really for hedge accounting, no real impact other than the immediate spot difference of what your actual cash flow difference is. Now I'll caveat that with, if you had a compounded in advance, this is where we talked about a 1 month in advance calculation, then there will be some hedge ineffectiveness. And that is because if you're hedging, you're out by a month basically, so you're hedging December cash flows with say a November observation period linked to your loan, that 1 month lag would create some hedge ineffectiveness. So I hope that addresses the question. So most practical terms for when you're dealing with 2 to 5 days, it's not really an issue, but be mindful of the actual cash difference coming through in your P&L. If you have a 1 month compounded in advance setup, then as we mentioned, really we don't recommend hedgers use that, because there will be some ineffectiveness that will come through. Okay, I think sticking with conventions, MAS publishes standard compounded SORA. However, the calculation of compounded SORA is different under different conventions, so look back and so forth. Are banks expected to calculate the rates themselves? So it's a good question. I might turn to Matt, or otherwise I'm happy to answer it, Matt or Jonathan.
Yeah, so I think, yes, it's, again, an important point, because it's one that can become potentially a bit difficult to handle if you have like small mismatches between what you are expecting to pay and what you are asking to pay. So the definition on how to use an overnight rate for quarterly interest payment, for example, can be a little bit complex, right? Do you shift by 1 day, by 2 days? How do you account for public holidays? When do you stop observing your daily fixing so that you have enough time to determine your final payment, and so on and so on. So we've seen quite a flurry of vocabulary and technical terms, which can be very confusing and in practice have a very, very small financial impact, but still can create these very small mismatches that can create quite a lot of trouble. That's why, indeed, the MAS has started to publish compounded SORA, which literally are rates that you can observe and decide to apply for a specific period. So the great thing about that is that it's a transparent number. It's calculated by a third party that is extremely reliable. It's very transparent, and it's much easier to ensure, if you have 2 contracts that needs to match, to ensure that if you observe the same index between the same dates, it will give you the same number. So you will save yourself a lot of troubles. It's not always applicable, and we are quite well aware of that. And that's when you need to be mindful about all these observation period shift, these lockout, and so on and so on. So in that case, yes, typically the bank, which is going to be the calculation agent in your contracts, will be able to publish that number. But it's important that if you are asking them, they can give you the full clarity on what is the impact of using this methodology as opposed to another one. Again, it is extremely technical. If you look at the actual financial impact, it is typically like a fourth decimal type of impact on your interest rate. But of course, it is important for you to understand, and you should engage your banks and your advisors to understand more the specific impacts when you can't use the MAS indices typically.
Thanks, Matt. Keep on conscious the bond market has also got different conventions. Any color to add on the different conventions and whether banks should be flexible in how they address these?
I would say that banks are certainly expected to be able to calculate, right, the rates and the versus what conventions are being used. I think it's more important that what the banks calculate and how the counterparties are able to calculate match up, right? So that creates a check and balance and a sense of over time that will become credible and people will feel comfortable with it. I think certainly a tool that all users can use, for example, on a platform like Bloomberg or Refinitiv, in terms of a calculator, just like a swap calculator, for example. So long as your conventions match up, in terms parameters match up, you should arrive at the same calculation.
I think that's very fair. I think if the question is aimed at banks, we would see that banks are starting to and expected to build in that flexibility to cater for these different conventions, particularly because you're not just dealing in Singapore currency, you're dealing in US and other currencies, and these conventions do differ. And of course, the very, very large end of corporates may find that they need to do some level of similar convention calculations themselves. But for the majority, we do believe the indices are a useful tool that would mean you don't need to do the calculation. Okay, so sticking with, I think, the conventions, for in arrears loans, how is the daily accrual to be handled by the systems as the rates will not be available at the end of the period? And so not having that rate at the end of the period may impact month-end and other regulatory reporting. A very good question. So happy to add some color, but perhaps Jonathan, if you'd like to kick us off.
Sure, Yura. So while it is correct to say that for a compounded in arrears loan, the interest rate fixing is not available until the end of the interest period. The interest rate fixing is really a composite of individual days' interest rates averaged together using a compounding formula. So, for example, at the end of June, if you have a loan that fixes on the 15th, you may still be waiting for the interest rate fixing on the 15th of July. So on the 30th of June, you don't have the interest rate fixing, but you do have the individual days interest overnight rates from the 15th of June to the 30th of June, right? You have all those individual days points. So those individual days points are what you are going to use to compute your daily accrual. So this is different from how daily accrual is done today, where typically you would take the interest rate fixing, such as 1 month, such as a 3-month SIBOR, for example, or LIBOR, at the beginning of the period and divide that by a certain number of days, and then accrue using a fixed number for each day in the period. In this case, the rate changes from day to day, but the mechanism of accrual is really the same. It is, you take a rate and you multiply that by a day count, and you multiply that by the principal outstanding. So you'll still be able to do that, in my example, for the last 15 days in June, and have that interest accrual ready for month-end reporting. So that's how we expect interest accrual will be done using overnight rates.
Yeah, thanks. Jonathan, agreed. So a question on conduct risk. So from a conduct risk perspective, SOR to SORA adjustment has to be equitable to borrowers and lenders. How can it be so when the basis cannot be easily established and measured? Industry guidance is needed. So a good question, just coming back to that SOR to SORA basis. I think we've touched on this previously, but I'm not sure, Joyce or Jonathan, Matt, any further comments to add?
I think on the regulatory side, our own regulator here, as well as regulators overseas, have made the point consistently to the banks in particular that this transition work that we're doing to move from the old LIBOR rates to the new risk-free rates or fallback rates have to be done with this overlay around fair dealing and customer protection. So those are principles that I think all the banks are very aware of. We're all subject to that in any case. So there will be that consciousness at the back of the minds of the banks about communicating clearly and effectively, regularly with borrowers and clients about what the impact of the transition would be on them, and to keep in mind that we have to treat our customers fairly and to minimize as far as possible any disruption to them or any impact to them on documentation, even economic impact if we can manage it. So I do think that the banks are conscious of that and the regulators expect us to behave accordingly. But as we've heard earlier, there is this differential between the old LIBOR rates that have a credit and term element to them versus the risk-free rates now, which do not. So there has to, in practice, be some form of adjustment to make sure that the rates are comparable. So it's a difficult question, I think, but a fair one for customers and borrowers to ask. And the answer that we have is that regulators expect the banks to treat our customers fairly and to discuss with them how this impacts them, and the industry as a whole would work to minimize impact as far as we can to customers. But it is something that cannot be avoided, the transition, simply because in some ways our SOR rate is so intricately tied to what's happening in US dollar LIBOR, and that decision is not in our hands. But hopefully going forward, as we've talked about, SORA itself is a rate that wouldn't have that kind of reliance on a different rate managed or administered by another party. So a good reason for us to think about moving to SORA again as quickly as we can. But even in that space, we are conscious of all of these questions coming in earlier about adjustment spreads and how best, as an industry, we will be able to address that particular question. Don't know if Jonathan or Matt or Keeper want to add anything in their space on that question.
Very briefly, I think the point of the regulation is to ensure a more transparent market. So I think clearly the intention is to make things better for end users, and these changes are pushed by regulators, not by banks. And as we've covered, everything has been done in consultation with the overall industry. So I think these are the safeguards on top of those Joyce have mentioned that I think people should take comfort in.
Thanks, Matt and Joyce. And look, I think it's a good question. I think it's good to see that question being asked, because the purpose of doing these sort of training and facilitation of and awareness of key concepts is to bring the knowledge of borrowers up, and so that you're better able to understand the economics and therefore have those discussions with banks. I think that's a pretty key part, the awareness side as well. A question for Matt now. I'm just moving to derivatives. What are the available options to reduce SOR derivative exposure as per the guidance from the SC/STS? And what are the implications of not complying with the guidance? So this question relates to the requirement to reduce SOR exposure for banks by 80% of your May 2020 exposure.
Yes, so I think this guidance is primarily directed at banks, to be very clear, if I'm reading the intention correctly. If you look at the statistics, a vast majority of SOR-linked derivatives are between banks. So I think that's why the impetus is on banks to help reduce the overall stock. It doesn't mean that corporates should not participate actively to that reduction in derivatives. And I think the simplest way is to analyze your exposure, and as and when you've determined that you are comfortable moving to the new benchmark, proactively recontract your SOR derivatives into SORA. An important point that we've flagged on occasion is that the default fallback, which is fallback rate SOR, will itself have a limited shelf life, right? So if you have long-dated derivatives, you might as well consider moving to the new benchmarks directly. So I think that's the overall point. The market is growing. You can start asking for quotes. The 14 banks participating to the working group #1 on derivatives have all traded SORA derivatives. So I think the market is clearly developing, and if you want to move to SORA, I think you should be able to.
Thanks, Matt. Okay, I'm conscious of time, so we'll probably take 2 more questions and then wrap up for today. Can you illustrate more how the transition to SORA affects existing fixed and floating rate fixed income securities? What are the key issues fixed income investors should be watching out for? Question for you, Kee-Pong.
Sure. With regards to floating rate instruments, it depends on if if the underlying is a floating rate. You look at whether the terms and conditions of those floating rate instruments have sufficient fallbacks. I think from the industry group perspective, for purposes of classification, we've bucketed them into type 1 or type 2 documentation. Type 1 documentation simply refers to existing terms and conditions of bonds, floating rate notes that do not have a fallback, and therefore some kind of discussion and engagement with bondholders would be required. Type 2 essentially provides some kind of fallback through an independent advisor approach, and depending on the type that the classification falls into, then issuers can take necessary action to see how they can get the transition going. The things to watch out for really is that floating rate certainly would be affected. The other instruments that would be affected in the Sing dollar space would be the resettable kind of notes, whereby it is predominantly fixed rate for a certain period of time, after which then the rate would be fixed again. Typically you see them in perpetuals or hybrids. You also see them in bank capital, whether it's tier 1 additional, whether it's tier 2 or additional tier 1. And the period that you normally see would be, for example, 5 years, 7 years, 10 or 12 years, right? So depending on when they reset, and if issuers need to think about what it will reset to, most of the time the reset is based on SOR plus the reset spread, right? So when it comes time for reset, if issuers reset, then that will be affected, because if SOR is available still, then you can use SOR. In the event SOR is not available, and if to the extent you have a fallback that you can use within existing documentation, then you do that. Else then you probably need to do a little bit more in terms of engaging the stakeholders, and then arrive at what would be a resettable rate. Of course, issuers also have the option to redeem, and therefore an opportunity to do a new contract or a new bond, right? And if it's a similar kind of instrument, then you can choose to use the SORA equivalent then.
Thanks, Kee-Pong. So last question that we'll take, and thank you so much for the very strong engagement we've had today. And this is a question again for banks. So while regulators are recommending transition to SORA and not rely on fallback rate SOR, are banks still required to have systems set up for fallback rate SOR? So I might start with this and then see if any panelists wants to comment. So I think the way to look at this is that if you have an inventory of SOR loans or derivatives where, as a bank, where transition to SORA is not expected, then you will need to have some way to value the derivative product and also determine the SOR, the fallback rate SOR interest calculations on the loan side. So for those reasons, I'd expect most banks to have the system capability to address fallback rates. But any comments from Jonathan, Matt?
I expect that banks would need to have systems set up to use fallback rate SOR because that's the direction of the derivatives market for transition of legacy SOR derivatives. And in addition, I think quite likely there will also be loans transitioning from SOR to fallback rate SOR, either because they want to follow their derivatives hedges or because there is a preference to use a fallback rate SOR from the customer side versus SORA. Because of that, we think that yes, banks should have their system set up to handle fallback rate SOR.
Great, thank you, Jonathan. And thank you, all panelists. I might refer back to Aibun to close the session.
Yes, thank you, Yura. And I join you to thank the panelists. And ladies and gentlemen, we have come to the end of today's session, and we hope you have found it useful. The session has been fruitful for you. So please let us have your feedback in the pigeonhole. And if you have more questions relating to this subject matter, please send them to sortransaction@abs.org.sg. And today's session has been recorded, and it will be up on the ABS website by this Friday, the 4th of December. So leaves me now to thank Yura, Matthew, Kipong, Jonathan, and Joyce for their time with us this morning. So once again, before we log off, may I remind you to complete and submit your feedback via the pigeonhole. So I thank all of you for your attendance and have a good afternoon. God bless. See you again. Bye.
Thank you.